Hi, I'm Helen Tarrant. How does commercial loans work in commercial property? You see, many people ask me this question about how do commercial property work, and especially how loans work. And if you're tapped out serviceability-wise with residential, can you still do commercial property? And the answer is absolutely you can do commercial property. And the reason you can do that is because you can actually borrow from the bank on commercial property based on the cash flow of the property rather than the focus on you. Now that's what we call a lease stock loan. Now the LVR for something like that could be 65%, so you have to top in a higher deposit compared to residential, but that means that the bank is not going to test you for servicing. Now that's really, really great. The reason for that is that it means that if you have five other residential properties, and that you have your principal home and you're negatively geared, you are not able to get a residential loan. But if you found a commercial property that's producing you cash flow, that's going to be able to make the mortgage repayments for commercial on a principal interest level, then the bank is going to give you a lease stock property. Now, how do you know if your property, the cash flow you're getting for this property, is going to come principal and interest? Now, I tend to think somewhere around 2 to 2.5% above what the interest is quoted by the bank. So for example, for a lease stock loan, they sit somewhere around 4.25, 4.5%. So not the most cheapest rate in the market, but also not the highest, because sometimes you want to bring an LVR up to 80%, you might be looking at 7% interest. So in this case, 4.5%, what you're looking for then is a property that sits 2 to 2.5% above that. So 2% is 6.5, 2.5 is 7. So you need a property that's minimally generating you 6.5 to 7%, preferably even higher. If you can get something between 7 to 7.5%, then you well and truly will cover the interest repayments. Remember, your loan is going to be an interest-only loan rather than a principal interest, but the bank will assess to see if you're able to service on a principal interest basis. So that means that if you can find something that sits 2 to 2.5% above what you're currently getting quoted as a bank as your interest rate, you should be able to get through and tick that box. Now, of course, everyone's situation is different, and your individual situation should be checked with a finance broker. So we get all of our clients to check through with our finance broker, so we know exactly the kind of loan that they have. So then we implement a strategy above it. The way I see commercial loans work, even when you can't get residential and you think you're too old, or that you don't earn enough money, all of those things are irrelevant in commercial property. As long as you have a deposit, some bank in commercial, may not be the major four, will do the deal. It's just a matter of loan to valuation ratio, whether you're going to be able to get 80% or whether you're able to get 55 or 65%. Now, that's also dependent on the property. That's the second part of commercial loans, where in residential, you buy a house, you buy an apartment, everything is pretty much cookie cut. But in commercial, it doesn't work that way. And the reason it doesn't work that way is because the loans and each of the property with the tenants are different. So the bank wants to look at the tenant. They want to look at the history of the tenant. They want to look at what rent they were paying, whether that's market rent, whether it's below market rent, if the outgoings actually match up, or whether the outgoings are a little bit higher. They want to check all of these things, and then they can give you an offer. They give you an offer, and for example, the offer could be, this is a 15-year loan or a 20-year loan, 25-year loan. The first 5 years is interest only, and it's going to be at, say, 4%. After that, it ticks over to principal and interest. Now that works very, very similarly to residential, which means that if after 5 years you want to refinance, you do the same thing as you would in residential and refinance the property, and you go through another interest-only period. If you're buying the property and you want to keep the property for lifestyle reasons and you want to use the cash flow to supplement your lifestyle, then I highly suggest that you use interest-only component and use the cash flow to either save up another deposit or use it towards your lifestyle, and then at the end of that 5 years refinance that property, so you're never paying down principal. Now if you absolutely love this property, and some people absolutely love this property, then I would suggest you do principal and interest repayment, so you can prepay down the property, and as the rent increases in your property, the tenant will help you pay down the property. But maybe for the first 1 or 2 or even 3 years, keep it as interest only, so that you build yourself a nice little buffer. So that said, hopefully that gives you an overview of how commercial property loan works, but I'll give you a quick recap. 1, whether you can service or whether you have enough income or you have too much liabilities in residential does not impact you getting a loan in commercial. 2, make sure you find a specialist broker in commercial property who does commercial property day in, day out. Now, if you need a referral, please put a comment in below, or you can go to helentarrant.com, send me a message through there, because I have someone that is an expert that we can refer you to. That's number 2, so you can get it checked and you get an overall finance position, which is really important. You know, finance positions in commercial sense tells you roughly the loan amount you can go, the purchase price, tells you the length of the loan, the type of the loan, and also the interest rate. So you get a really good idea that helps you to go shopping. Number 3, now the tenant and the property matters. So the type of tenant, the history of the tenant, the property itself, and the location matters, because the bank wants to assess their risk factors, and because of the risk factor, they're going to give you an offer on the property. So it's not a cookie cut loan as such. So just remember, and this is my analogy, if you found a property and it's in a mining town, it might be yielding 11, 12, 13 or even 15%. It might be on a 10-year lease, and it might be fantastic, and it might be a branded tenant. You go to the bank is going to look at it, goes fantastic, understand your cash flow, understand everything. But let me ask you this question: who's going to support this property if the tenant goes bust, or if they do a runner on their lease? Now, so you better be showing me some income to be able to show me that you can tolerate the risk and that safeguard for ourselves, or we want you to give us more deposit. So, and which means that you're going to have to be a really good earner, you're going to have some assets behind you, or you're going to have a chunk of cash to be able to put into this property. Now, let's change that scenario to a property located in Sydney or Melbourne Metro, and it might be only a $1 million property, and it might only be an office space with just a generic tenant in there, so it's not a brand name tenant, and it might be on a 3-year lease. The bank is going to look at that and go, you know what, this tenant, we know that in an area like this, you'll get a re-tenant, you'll get a new tenant in there if the tenant goes bust within 2 to 4 weeks. We're not particularly worried about that. The yield is acceptable, is going to cover our repayments, and really we don't care if you're 40 and sleeping on your mother's couch, and almost on the dole, as long as you can actually have a deposit to put in, we'll do the deal, because we know the property is going to be self-sustaining on its own. So the stronger the property, the less strong you have to be. So if you're starting out in commercial property and you're not that strong financially, then find a really strong producing property, even if it's on a shorter lease in comparison to a property that has much, much higher yields, much more returning cash flow for you, but it's in a regional or rural area, because the bank is going to compare the risk of these two properties, and then they're going to look at whether they want you to be part of the loan process or not. But at the end of the day, please find specialist opinion about it. I look forward to helping you in your journey. Don't forget to subscribe and hit the bell, and I'll see you in the next episode. Bye for now.